Absolutely. So I mean, look, if you think about the success rate that a founder has and the number of meetings that a founder might need to make to get a term sheet, it is significantly higher for a VC. It is much, much more difficult for a VC to raise, which again, you might think is difficult, particularly for a founder if you're going through the process or you've just come out of the fundraising process and you're feeling particularly bruised and battered and it's taking you, 6 to 9 months. So you're speaking with people, all of these people you're speaking to have money. But for them, it's been very difficult. And I think that was probably quite well evidenced by the number of people that applied for our emerging VC program. We had over 520 funds across Fund 1, Fund 2, Fund 3 apply for 20 places in the program. So I think that, these are all professional investors who, have very, very good experience, great track records. But I think just that in itself demonstrates how hard it is to raise capital. You can see it in some of the data in terms of lots of them, a lot of the money that at the moment is going to, the very, very large, very established VC funds, and some of the newer, more niche funds are being sort of crowded out. So it's so much harder to be able to get in and sort of convince someone to part with their money, because you're dealing with institutional investors who they are taking a very significant risk on you. Often they are working with, you're having to work with asset allocators who want to be able to deploy very regularly into very large funds. So the incentives are quite there sometimes for the smaller fund managers in particular.